We would characterize 2019 as a year of recovery after a very weak 2018. The year began strongly after the intervention of global central banks led by the Americans, who began reversing previous policies and cutting interest rates. And this had an immediate effect on sentiment, which steadied, and on markets, which rallied strongly. The summer and early autumn was pretty quiet, and the final quarter of 2019 brought with it a significant reduction in political risk. Part of that was in the UK, where the election of a government would bring some form of certainty to Brexit. And almost simultaneously, on the other side of the Atlantic, the Americans and Chinese reached an interim truce in their trade dispute, which had been a significant issue for investors for the last 2 years. So that reduction in uncertainty meant we ended 2019 in much better shape than we began it. When we think of the year ahead, our mindset is one of measured optimism. There are plenty of positive supports out there for your portfolios and for markets. The most important one being the low interest rate environment and very proactive central banks. Whenever there's a lot of cheap money in the world, it tends to support stock and bond markets. And at the same time, we have significantly less political risk than we had in 2019. However, there are some offsets. Markets are high, valuations are generally rich, and it's hard to find value. At the same time, economic growth is not yet firmly established, and that is a risk. If we put it all together, on balance though, we do think there are more reasons to go up than to go down, and we have a reasonable degree of optimism that we should be able to deliver another year of solid returns. When we think about what we're going to do in your portfolios in the year ahead, the investment committee is going to keep one word in mind, and that word is balance. We do see some value in some parts of the risk spectrum, equities, particularly in the United Kingdom and in Japan, and we'll be building up both those positions over the course of the year. We see some opportunities in what's called alternatives. I mean, specifically, that'll be finding managers that make loans to companies to finance their international operations. Also finding managers that trade interest rates, because there's a great opportunity set there. On the more defensive side of the spectrum, we'll keep the gold and we'll keep the gold mining exposures, which did very well for us in 2019. And we'll aim for about a 20% exposure to the US dollar. The US dollar tends to do pretty well in times of stress. That's a good offset to the risks we're taking elsewhere in the portfolio. If we had to summarize, we don't think there's one big opportunity one way or the other. There's no big skews in the portfolios. We do have lots of medium-sized ideas that we think we can blend to provide a good balance of risk and reward.